Two firms looked at the same S1, the same revenue numbers, the same rocket launches, the same Starlink subscriber count. One came back with $1.77 trillion. The other came back with $780 billion. The gap between those two numbers is $990 billion. That is not a rounding error. That is larger than the entire market cap of Walmart. And the most important thing about that gap has nothing to do with SpaceX at all. It has everything to do with who is standing behind each number and what they get paid to believe. If you are managing your own portfolio and you've been trying to figure out whether $135 a share is an opportunity or a trap, this is not a hype problem. It is a structural problem, and once you see the structure, you cannot unsee it. The number on your screen says SpaceX is worth $1.75 trillion. That tag was set by the banks underwriting the deal. 23 banks. Goldman Sachs leading the syndicate. Goldman's CEO publicly congratulated SpaceX and described their strong partnership. The $780 billion came from Morningstar. Their analyst does not get paid if you buy. That asymmetry is the entire story. Before we pull the numbers apart, if you want more breakdowns that respect your intelligence and skip the noise, this is the Paycheck Lab. Subscribe now so you do not miss the next one. Let me show you exactly how two credentialed teams working from the same document arrived at numbers that differ by nearly $1 trillion. And then I want to give you the framework to read every IPO valuation you will ever see again. We need to start with what I call the incentive gap. This is the structural distance between the people who get paid when a deal price is high and the people who get paid to tell you what something is actually worth. It is not a conspiracy. It is just a principal agent problem that has been hiding in plain sight for decades. When Goldman Sachs leads an IPO, they earn underwriting fees tied to the deal's success. They work for the issuer. Their job is to get the highest price the market will absorb. That is not a criticism. That is a contract, but it means the number they hand you is built to accomplish a specific commercial objective. It is a price the market will pay, not a price the asset is worth. Those two things can be very different. Morningstar earns subscription revenue from investors who need independent analysis. Their job is to tell you what the asset is actually worth relative to what you are being asked to pay. Same S1. Different employer. Different number. The incentive gap is the reason those two things almost never converge at IPO time. Now let me show you what the math actually looks like on both sides of that gap. Morningstar's analyst Nicolas Owens built a discounted cash flow model with three scenarios. In the base case, he values SpaceX's core launch business and Starlink at roughly $40 per share. Add the cash SpaceX will hold after the IPO proceeds, that is about $6.50 more. Subtract net debt. You're at roughly $46. Then he probability weights three separate AI scenarios, from conservative to moonshot. The AI component adds $16.50 per share, total $63. That is his fair value estimate. At $135, you are paying more than double what the math says the business is worth today. Here is what makes that number sobering. The moonshot scenario, the one where Starship achieves full rapid reusability and orbital data centers become a commercially viable business, produces a valuation of $154 per share. Morningstar assigns that scenario a 7% probability. So to break even at the IPO price of $135, you essentially need to believe in a future that a rigorous independent analyst thinks has a 7% chance of happening. And even then, you barely get out ahead. Aswath Damodaran ran his own model independently. Damodaran is a NYU Stern professor who publishes every assumption in his spreadsheet for public scrutiny. People in the finance world call him the Dean of Valuation. His number, $1.3 trillion in equity value after adding the IPO proceeds. That is about 28% below the $1.77 trillion offering price. Damodaran himself said the stock could still run higher on momentum and that it might stomp you even if you are right on the value. He is not saying the company is worthless. He is saying the gap between intrinsic value and IPO price is real and significant. Imagine 3 bars on a chart. The first bar reaches $780 billion. That is Morningstar. The second bar reaches $1.3 trillion. That is Damodaran. The third bar towers above both of them at $1.77 trillion. That is the IPO price Goldman set. The distance between the first bar and the third bar is $990 billion. That gap has a name. I call it the source premium. It is the portion of a valuation that comes not from the assets of the company, but from the incentive structure of the people who built the number. Now let me give you the financial context that makes those bars mean something. SpaceX reported $18.7 billion in revenue in 2025. At $1.77 trillion, you are paying roughly 94 times that revenue. Not 94 times earnings, 94 times sales. The company lost $4.9 billion on a net basis last year. The AI segment it acquired through the xAI merger in February 2026 lost $6.4 billion at the operating level in 2025. Starlink is genuinely profitable and growing fast, but right now, Starlink is essentially subsidizing xAI's losses. The profitable part of SpaceX is carrying the unprofitable part, and you are being asked to price the whole package at 94 times revenue. For comparison, Nvidia is the most enthusiastically valued AI company in the public markets. Nvidia trades at roughly 20 times revenue. SpaceX is asking for nearly 5 times Nvidia's multiple. For a company that is currently losing money. Now I can hear the objection forming. You might be thinking, Caspian, this is exactly what people said about Amazon in 1997 and Tesla in 2010. And they were wrong. Both companies went on to produce returns that made every valuation model look small. That is the strongest argument for the bulls, and I want to take it seriously because it is not wrong. Damodaran acknowledged it himself. Independent analysts said Amazon was uninvestable at its IPO price. Amazon became one of the greatest investments in financial history. The pattern of visionary platform companies exceeding even the most optimistic discounted cash flow models is real. If SpaceX succeeds on all 3 fronts, launch dominance, Starlink at global scale, and orbital AI infrastructure, the $1.77 trillion valuation may one day look cheap. The Paycheck Lab is not here to tell you SpaceX will fail. But here's the conditional truth that the bull case requires. Amazon had earnings within 3 years of its IPO. Tesla had a clear path to positive cash flow that skeptics underestimated. SpaceX's AI segment, the one that tips the entire company into a net loss, was acquired 6 months before the IPO in an all-stock deal that was not conducted at arm's length. The engineering problems behind orbital data centers have not been solved. Morningstar flags them as scientifically uncertain at best. The bull case is real. But it requires specific conditions to be true, and those conditions are not priced as uncertain at $135. They are priced as nearly inevitable. So how do you actually use this framework when the next IPO lands in your feed? Step 1 is to locate the source premium before you look at the valuation number. Before you ask what a company is worth, ask who built the number you are looking at and what they are paid to believe. An underwriter's valuation and an independent analyst's valuation are different instruments measuring different things. One measures what the market will pay on a specific day. The other measures what the cash flows of the business are worth over time. Knowing which instrument you are holding changes everything about how you use the reading. Step 2 is to find the incentive gap. Look for at least one valuation that comes from someone with no financial stake in the deal pricing high. Morningstar, an independent academic, a firm that earns nothing from the transaction. If every number you can find comes from parties who benefit from a higher price, you are not looking at a valuation. You're looking at a marketing document. In SpaceX's case, you have 3 independent data points below the IPO price. That does not mean the IPO price is wrong. It means the gap is wide enough to take seriously. Step 3 is to price the scenarios honestly. Morningstar built 3. Dumoduron built 1 with conservative assumptions. Neither's trying to scare you away. They are trying to tell you what probability distribution you need to believe to make the math work. At $35, you need the moonshot. At $63, the base case pays you adequately. At $1.3 trillion total, Dumoduron says you are paying a premium, but not an absurd one if the business executes. Figure out which scenario you actually believe in and whether the price you are paying matches that belief, not someone else's. You might be asking, why does any of this matter if the stock went up 19% on day one? I want to address that directly. The first day pop is exactly what the incentive gap predicts. A small float. 23 investment banks driving institutional demand. Index inclusion coming within 15 trading days. All of that creates buying pressure that has nothing to do with intrinsic value. Morningstar said the stock would likely survive separation and even ascend for a time. The question is not whether SpaceX trades above $135 in the next 6 months. The question is what it is worth when the float expands, the lockup periods expire, and institutional index demand normalizes. Owens flagged it clearly. Insider selling in the coming year is very likely to greatly increase the supply of shares. Supply and demand, not just valuation math. Here's the synthesis. The incentive gap does not make $1.77 trillion wrong. It makes it structurally suspect until confirmed by independent analysis. In SpaceX's case, 2 independent credentialed valuations came in meaningfully below the IPO price. That is information. It does not tell you the stock will fall. It tells you the price you are being asked to pay reflects a set of assumptions that are not yet in evidence, priced in by people who had commercial reasons to price them high. SpaceX might be the most consequential company of the next 25 years. The Starlink business is real and profitable. The launch cost reduction they have achieved is genuinely historic. If you believe in the platform and you have a 10+ year horizon, buying below the independent fair value estimates might eventually look like the right move. Morningstar's own analyst said patient investors will likely get that chance after the IPO excitement passes. The framework is simple. Every time you see a bid number attached to a new offering, ask 2 questions. Who built this number and what do they get paid to believe? Then find the number built by someone who gets paid to be right, not to close the deal. That is the source premium. Once you can see it, you will find it everywhere. Drop a comment below. What is your read on SpaceX? Are you buying the technology story at any price? Or are you waiting for the independent valuation estimates to become the floor? I read every one. If you are managing your own money in the 30 to 55 range and you want breakdowns that run the numbers instead of running the hype, hit subscribe. We publish one of these every day. I'm Caspian.